You're listening to Lender Lounge with Kevin Kim, a podcast dedicated to the private lending industry. I'm Kevin Kim, and my goal is to sit down with key figures in the private lending industry to talk about their business and their personal lives. We'll get their takes on market conditions, the industry at large, and their personal stories. Overall, I really want to learn more about how they started and grew their businesses. So whether you're a lender, a borrower, a vendor, an investor, or anyone just interested in learning more about private lending, this podcast is definitely for you. Thanks for tuning in and enjoy this week's episode of Lender Lounge with Kevin Kim.
So what is Lightning Docs exactly? Well, Lightning Docs is the gold standard in document automation software for producing business purpose loan documents all over the country. Whether you're working on a short-term fix and flip or a 30-year rental loan, Lightning Docs has you covered in all 50 states. Our staff here at Geraci is constantly working to ensure that Lightning Docs is kept current with all the ever-changing laws and regulations, so you never have to worry about your document set being outdated or providing you with inadequate protection. Our goal here at the firm is to provide our clients with peace of mind, which means that we're always working to provide you with the best and most streamlined user experience possible. Whether that means getting you set up to pair Lightning Docs with your LOS system, setting defaults in our interview, or just changing some of the language in our document set, our staff is always ready and willing to help you with whatever you may need. Whether you're a private lender, a broker, bank, credit union, title company, you name it, Lightning Docs is the solution to all your loan document needs. For more information, please go to www.lightningdocs.com.
Hey guys, Kevin Kim here for another episode of Lender Lounge with Kevin Kim. Today we have a very special guest, Keith Lind with Acra Lending. We've been trying to book this episode for a while. We talked about it. Hey, when are we going to do this episode? I'm so glad we're doing it today. You are in your office today, right? I am. All right. Thank you for joining us on the show.
Thank you for having me. I know
it's very busy right now. Everyone's traveling like crazy to different conferences and stuff like that. So we're about to enter a pretty big conference season pretty soon. So please introduce yourself for the audience and tell us a little bit of Acra, and we'll get started.
My name is Keith Lind. I'm the CEO of Acra Lending. Acra Lending is probably one of the larger private lenders in the U.S. The company was founded in 2014 by the previous owner, focusing specifically on non-QM. So post the housing crisis, think about there were no real guidelines to private lending, and then the CFPB and Dodd-Frank introduced the concept of ATR, ability to repay. And that sort of put the guardrails in place for Acra to start lending. And that's what the company was founded on, was non-QM.
Mm-hmm.
I stepped into the company in 2020 after a transfer of ownership from HPS Investments, which is where I was previously employed for 3 years, from 2017 to 2020. And upon the acquisition, I was asked to come over and run Acra, along with Kyle Gunderlock. And 2.5 years later, we've almost doubled the size of the company. We did $2 billion of originations in 2021 in non-QM. This in 2022, we'll do about $2.3 billion of originations. And we recently launched our fix and flip and bridge origination platform. So we're very excited about that coming into 2023.
And so that's a really great place to start. Is so you guys have just added the fix and flip. Well, your entree into the private lending sector was non-QM. You guys started in non-QM. You guys continue to do non-QM. But and I'm sure you've been asked this a million times, but non-QM is this. It's an industry term, and it's not really a term of art. And really, almost anything that's non-qualifying kind of fits in that bucket. And so, from our listeners, in the private lending sector or the hard money sector, it's been kind of a weird amorphous concept. So tell us from your perspective, as one of the industry leaders in non-QM, what exactly does it mean? That's one of the strangest things.
So I agree with you. It's somewhat the standard, call it hybrid acronym in the industry,
right?
So again, post the housing crisis, the government came up with a concept of a qualified mortgage, and a qualified mortgage is really a consumer loan that is eligible, right, through Fannie and Freddie. But unfortunately, that excludes a fair amount of people in America, specifically the self-employed, where if you don't have a W-2, you can't get a loan through Fannie or Freddie. So hence, if you're self-employed, you don't qualify. So you're non-qualified per se, hence non-QM.
Right.
And that's really where it was based from. But it's a growing part of the U.S. loan market, mm-hmm. right? More and more people want to be self-employed. Less and less people, right, every year want to work for a big corporation.
Right.
There's more entrepreneurs today than ever before, and that's right. The gig economy is growing. And if you look at our production, 50% of it is consumer loans, people purchasing a home for themselves, right, where they're mm-hmm. self-employed or have their own business. There's other examples too. Just self-employed tends to be the largest one, mm-hmm. but the other 50% of our production is investor loans. So small mom and pop.
Was that always the case back, even starting in 2014?
It wasn't. So yeah, it wasn't. The investor portion has grown significantly, and I think huge tailwinds in that mm-hmm. sector, given what's going on in the stock market. Mm-hmm. Now, home prices don't go up forever, but if you've been an investor buying investment properties, the last 5 years has been very, incredible returns.
Sure.
We see that continuing. If you got to look at the technicals, we're short 5 million homes in the U.S.
Right.
And that was due to the fact that builders stopped building during the housing crisis, and really, the pandemic really brought this out to light. Mm-hmm. And people didn't want to live in apartment communities. They wanted their own house.
Right.
And we think that's a huge tailwind moving forward. And also, again, look at stocks. They're down 20+%.
Oh, yeah.
Will housing have a correction? We believe so. Do we think it's going to be 20%? We don't. But again, in the stock market, you're buying companies or investing in companies where most of them don't even pay you a dividend or cash or any cash. Housing does.
Right.
So I think, moving forward, there's going to be, just a lot more confidence in the housing market for investors mm-hmm. to buy investment properties.
So I mean, the investment property component of Acra's business, it sounds like it was a relatively new addition. Was that after you had joined, or was it before that?
No, they had it prior to me coming here, but it's just been a bigger focus. I'll give you an example. When I stepped in, Acra's business, when it was founded, was built off brokers. Mm-hmm. A very minimal focus on retail and correspondent, which is something mm-hmm. that we've grown since I've gotten here. But one of our focuses was, on from the standpoint of dealing with brokers, we only dealt with licensed brokers. Mm-hmm. And when I stepped in here and we started peeling things back and looking at the way the company was running and how we were targeting investors to purchase homes, well, we realized, and I realized that there's a huge market out here to tap brokers who are unlicensed.
Yes.
So with the help of Geraci and Kevin and his teams, thank you very much, we were able to go state by state and figure out, okay, where can we start marketing to non-licensed brokers? And that's been a huge success for us and increasing our volume. And that's
big change of pace when you're dealing with all that consumer compliance, right?
Well, that's right. That's right. But that's why we're at 50% investor when 2 years ago we were at 25%.
Right. And was the initial thesis around kind of the term rental program? Or what was the focus for a while? Or was it all the food groups in our sector? Because you said you just added Bridge, you said recently, right?
So we've added, we've expanded our DSCR or investor loan. Mm-hmm. We have added small balance multifamily.
Great.
Permanent financing, 5 to 24 units.
Fantastic.
And then we've added Ridge and fix and flip mm-hmm. for 1 to 4 and 5 to 24. Mm-hmm.
Mm-hmm. Okay.
On the multifamily side.
So, I mean, I want to get deeper into that and also those tailwinds you're mentioning, but I still feel like our audience wants to get to know you a little more because, I mean, I've been in this space now 8 years, and I remember seeing Acra at a few different events, and then all of a sudden, Acra really blew up in our sector, in the private lending sector. I started seeing you guys everywhere, and then we met 2 years ago. And so, I feel like our audience know that they know about Acra. They know what you guys do, but I was reading your bio, and you come from a capital markets background, right?
I do.
So tell us a little bit more about yourself.
Yeah, so I started my career on the other side of this, not where the loans were made, but where the loans end up. So started my career after graduating Purdue University in 2001. My first job out of college was at Bear Stearns, and it was on the fixed income trading floor in New York. And my first 2 years at Bear, I was on the structuring side. So the modeling side, figuring out when loans do get securitized, modeling cash flows, whether it be for non-agency, ABS, multifamily, commercial real estate, CMBS side. So I spent 2 years there, and then after 2 years, I had the opportunity to go to the trading desk where I started trading loans, purchasing large loan packages. This is 2005. So think about the next 3 years leading up to the crisis. So
you were there on the ground.
I was buying loan packages, 500 million to $1 billion on a clip.
Right.
And then structuring them up and then going out to our through our sales force and selling the bonds to our institutional clients.
Right.
So fast forward, housing crisis takes place and Bear Stearns gets acquired by JP Morgan. 13 of us left Bear Stearns. There were 7 traders and I think 6 salespeople got recruited to go to Royal Bank of Scotland to build out their capital markets business. So we were there from 2008 to 2015, where I was running our loan trading desk and also QSIPs. And then they decided to get out of the capital markets business. And then my boss and I were recruited to go to Brevin Howard. It's about a $40 billion global macro hedge fund based out of Geneva and London, founded by Alan Howard. We were there from 2015, 2017.
Still doing the same thing?
Still doing the same thing, structured products, trading bonds, still distressed bonds from the housing crisis.
Sure.
And then in 2017, we were recruited, both of us again, go to HPS Investments. They're about an $85 billion private equity fund based out of New York, solely focused for the most part on corporate credit, but they wanted to get exposure to the structured products, or what I'll say is housing related or real estate related structured product side. So I was there for 2 years, and there wasn't much to do because the distressed opportunity was starting to fade. Prices just were approaching par again, so the convexity or upside just wasn't there on the bonds. And I had pitched to my boss Purnima Puri and the other partners at HPS about getting into the private lending space.
Okay, what year was this?
That was in 18, middle of 18.
Okay. So that's when things were getting hot and heavy in the private lending sector. Yeah.
Yeah, that's right. Yeah. So, and it was sort of ironic because we met with 4 companies and one of them being Sprout. So we were able to get under the hood and just see what Mike Strauss was doing. And we talked to Deep Haven, which got acquired by Pretium. Yep. And so those were the main 3 that we cared about, meaning the third one being Citadel Servicing, which is now Acra.
Right.
And, after taking a hard look, I'm confident to say we did make the right decision.
Sure.
Citadel the previous owner built a very buttoned up attention to detail platform. Second to nobody that we spoke to.
Right.
It was that buttoned
up. You have to be in servicing. You have to be real tight in servicing, which is a really good move.
Not just servicing, but the origination side as well.
Oh yeah, but the nice part is they brought that mentality with them on the origination front. I noticed that early on.
We are one of the only non-QM originators that originate and sell our loans servicing retained. We retain all the servicing.
Right.
So we have 2 businesses. We have the servicer, and then we have, which is Citadel Servicing. Then we have the originator, Acra Lending.
Right. And for a lot of us in the space, Citadel's reputation preceded Acra before it came out. I didn't know Acra was owned by Citadel until I started looking into the company. I was like, oh, that's really impressive, because Citadel has had a great reputation over the years as a really strong servicer.
Yeah, as a strong servicer. The reputation on the origination side, needed some improvement.
Oh, sure, everyone does. I mean,
but hence why we rebranded to Acra,
and
that was the message to the market: is we have new ownership, we have new leadership. and we're going to do things a little bit differently.
Well, I want to go back to that 18 event though. When you're pitching the partners at HPS about this, what was it about the industry that from your perspective? Because we don't get a lot of folks that were on the ground floor on the secondary side, on capital market side.
Yeah,
and it's very hard to hear these perspectives on the show. We only get a few of these opportunities, so I really wanted to hear from your perspective on this, because in 18 things were just starting to really heat up in this sector.
So that's what we saw. My background is really on the other side of talking to originators every day and wondering how can we aggregate loans and securitize them. And
sure.
When you're on the sell side, we're talking to customers who want to own the equity, who want to own the lower part of the capital structure and the top of the capital structure. Our pitch was, the pitch that we went with, myself and the deal team, was exactly that. This is a nascent opportunity coming off the housing crisis. Guardrails were just put into place regarding ATR. This is a huge opportunity. And if you look at how much more stringent the underwriting is today versus the housing crisis. I mean, the housing crisis, most of those were 100 LTV loans. There was an 80 and 20.
Yeah, you just needed a pulse to get along.
Yeah. And today's just a much different story. And, it's people are held accountable for what they're originating.
Yeah.
And that was really the opportunity is, if we can find a platform that's been built, to the standards that we want, this is a huge opportunity. And we found that in Citadel Service.
So it sounded like there was a lot more comfort, because the opportunity was pretty self-explanatory, but the comfort level as compared to the subprime crisis when it came to the underwriting guidelines, that was one of the factors that really pushed the needle for you guys to move forward then, right?
Yeah, absolutely. It was, I was just looking at our production. Our production's been pretty consistent since we bought the company.
Sure.
So you're talking, $4.5 billion of originations at a 67.7 LTV.
Right.
You're putting down 33%. That's skin in the game. And
right.
We expect, or anyone would expect, those loans to perform well, and they are. And even, during COVID, there was a pocket of stress there. But again, this will be the real test. And I think even through COVID, I was speaking to investors back in New York when they knew I was coming here. But even when we got through COVID and people saw their performance, a lot, multiple, and I don't know, I'm not going to throw a number out exactly, but we saw a lot more institutional interest into non-QM because it sort of got put on the map and it performed well through COVID. But I think the next year or two is going to be very telling. But we're extremely confident in the strength of the borrowers that we lend to.
That's fantastic. I want to talk to you about kind of the transition into what we call private lending, because non-QM was kind of the initial foray, and then you guys added more what we call private lending stuff. And I think that the in-between component was the investor term rental loans, right? Those long-term loans that didn't really hit the space until 19-ish. But the transition must have been a kind of a culture shock for you guys. Talk about that real quick.
Yeah, it very much was. I'll just go back to, the previous owner who built this business. Again, attention to detail and process was everything. And we're very buttoned up and proud of that. When you step into the transitional space, it's sort of, the Wild West.
A little bit.
Yeah.
Comparatively speaking, it's like commercial. So it's very, very minimalist underwriting, comparatively speaking. So
I think, we hit some bumps in the road because we wanted to somewhat belabor the files and the underwriting and the attention to detail. When then we realized, well, these aren't consumer loans. They're not going to be regulated like consumer loans. We spoke to other investors and other lenders to figure out, okay, what are you comfortable with? Because the institutional accounts that we sell our loans to were clearly already participating in transitional loans. So we just got a better feeling from them of what they're comfortable with, what they think is market. And then we had to adjust our processes and sort of start from scratch almost. And a year later, we're there. And we're very confident with what we have. We built an in-house proprietary technology, or LOS. But again, I go back to Geraci and your team. It was a huge help for us, answering those hard questions, because we are buttoned up and we want to do things right. And our attention to detail is always going to be there. how, what do we need to do and what don't we need to do? And those are
and
the
that was the hardest
answers
part. I feel like it's just one of those like, I can't believe it's like I can't believe it's not butter. I can't believe it's that straight, that simple. So, but the RTL space for you though, actually raises another question for me, because back to your capital markets background, was the RTL space on your radar back then?
It wasn't.
It wasn't. Okay.
We had heard about it. It just wasn't scalable yet. From the standpoint, non-QM was scalable. We knew we could buy.
Sure.
We could get
being securitized.
We could buy $500-600 million over a couple months. The transitional or RTL side just wasn't there yet.
And is that because of a lack of bond sales happening? Only a handful of bond sales being structured back then.
No, there just wasn't. The ROCs and the TORACs were just getting going.
Yeah.
So they were just starting to scale, and that's
18 was when they really started to pick up a lot of volume.
But that supply was spoken for. They already had partners. So as we were looking for those loans when I was in New York, they weren't readily available like non-QM was.
I see. It's a matter of volume, nationally speaking.
That's right.
That's true. It's a much smaller market. That makes sense. Okay. Very cool. All right. So I want to talk about those tailwinds you're mentioning earlier, because those definitely, I love this kind of stuff, and I really appreciate what you just said, what we said earlier about the tailwinds in this industry, and I really want to kind of get into that, because I mean, for our listeners right now, we're recording. It's September 29th. We just had another Fed rate hike not too long ago, and there's a little bit of disruption going on. A lot of people are speculating and freaking out, and you mentioned the stock market, and it's not doing so well as a kind of understatement. I really want to get your thoughts on that. Like where we're headed. Where do you think we're headed?
So just take a step back the last 9 months. Coming into this year, call it 4 or 5 months into the year, 6 months into the year, 7 months into the year. So 4 months into the year, the only two assets that really held up that were doing very well were commodities, oil, specifically, and housing. And now, if you look at the last 3 months, what started to go sideways is commodities, based on growth fears and higher rates and slowing down the economy.
Right.
Not just here, but overseas as well.
Right.
So the last asset class that is holding up, and we expect there to be some cracks. We expect, housing just can't go up forever. It's just not going to.
Sure.
But the stock market, $11+ trillion wiped off. Bitcoin, $2+ trillion wiped off the market value. Those are staggering numbers. Now you're looking at what's happening with oil, and that's going to be very dependent on what happens over, in the geopolitical stuff going on with Ukraine and Russia.
Right.
But we're bullish on housing, and I think investors are as well. But again, understanding the fact that housing doesn't go up forever. Are certain areas, in our opinion, like Phoenix, Boise, Denver, Nashville, these places that are up 100, 200, some neighborhoods 300%, that's going to settle back down to earth. Everything comes back to equilibrium, and you have to look at the way we think about it is, okay, wages are going to start going down. Wages don't go up forever. So when wages start going down, and people, there's always the affordability equilibrium. And now, compounded with that, wages, you have to understand, interest rates have doubled since the beginning of the year. I was just looking at our production in December of 21, our coupon that we funded, $261 billion at a 4.55 coupon. Our August production was an 8.05 coupon.
Right.
So payments are higher, and that's going to cut into to people's affordability to make payments. And then you also have, wages are going to probably settle down. So the places that had, massive spikes is what we'll say. We think those come back down to earth, but we are still very bullish on different parts of the U.S. where jobs are being created, where companies are moving to, and that's getting noticed by investors that are coming to us for loans.
And that raises an interesting question, because MSRs that have that demographic growth because of job creation are the same markets in a lot of ways. I mean, some of them, Texas, Phoenix, Austin, Texas specifically, Austin, Dallas, Phoenix. These are cities that have, and Boise as well, have been built, and even Reno have been recruiting these businesses to set up shop there, and thereby recruiting more people. And so, but by that virtue, HPA is out of control, right? Phoenix is one really good example. It's insane over there. And so it raises an interesting question. Aren't those the same markets that are overinflated or over, and won't that equilibrium, but will that demand side of things keep HPA at more of a steady, I guess, not upward level, but plateau it? Will you, because you're saying it's going to come down. I've heard a few different people postulate because of the amount of job growth happening in these cities, they just don't have the infrastructure to support it.
So one rebuttal to that. Job growth, the government's doing a very good job of halting job growth.
Oh, yeah, that's true. Their goal right now is to create.
But that's their goal.
Yeah.
So that's their goal. So with that goal in mind, I'll take the other side that, again, it's just not going to go up forever. And
right.
with
it has to come down eventually.
Well, you're seeing what's happening. Every market's being affected by this. And
yes.
You can't, people can't afford homes when you double the interest rate that they were buying a year ago.
Sure.
And the one thing that we're seeing, which is pretty interesting, the average balance of the investor loans that we're funding are much lower than they used to.
Yes.
But that's smart, right? Because there's more upside in a $200,000 home than there is for a $600,000 home.
Yes. And we saw the same thing in our platform too. We saw a significant decline in loan amounts.
Yep.
Rates are climbing, but loan amount, which means leverage is shrinking, which is a great thing. People are being more conservative.
That's right.
But lenders are being more conservative. But at the same time,
but so are investors, because they're going after those lower balance loans.
Right. But at the same time, the interesting question mark becomes, kind of like how, even in the recession, there were certain markets in California that just didn't take a dive comparatively to other cities that didn't have the stability that you have in California.
Yep.
And so will we see the same result? Because you have this massive inflation in value in Phoenix and Las Vegas. And I mean, Reno is a different story, but it makes you wonder, how bad
we're seeing a lot less loans from California. Our California percentage is going down, and it makes sense.
Right.
Especially from an investor perspective. Do you want to be buying investor homes in California?
Probably not.
Well, think about how tight the cap rates are.
Yeah.
They're extremely tight. So are there other...
And that's another fascinating issue, is that the cap rates aren't moving like they should. They should be moving, but they're not.
But there's a lag with that. And as rates go up and people, there's less homes being bought by investors, cap rates will widen out.
Right. So what I'm hearing is you're still optimistic, but the party's kind of over. The party's over. Let's get
I guess, yeah. If the people that got used to buying a home and flipping it up 50% or I think that's over.
I hope you're enjoying this episode so far. Nadel is a proud sponsor of Lender Lounge. Nadel helps connect companies to end users through branded items, custom items, and creative solutions. They have collaborated with established, globally known enterprises and the most exciting up-and-coming companies to create unparalleled branded experiences. With attention to the smallest details, Nadel helps you pursue your biggest goals. Their founder, Jack Nadel, first began creating branded merchandise in Culver City, California in 1953. With Nadel, products and experiences are transformed into memorable brand moments. For some, that means providing something immediately useful, like the perfect notepad or eco-friendly water bottle. For others, it's more intangible. They're creating something of sentimental value to take your breath away. Whatever you're looking for, Nadel can make it happen. Perfect for trade show giveaways, new hire gifts, awards, and more. For inquiries, please reach out to Ben Goldberg at ben.goldberg@nadel.com. So I guess because of your background, I'd like to ask you this, because I was listening to the news this morning, and Larry Summers, the one of the economic advisors to the Clinton administration, made a comment about what he views as the kind of lacking component of all the policy right now is supply side. Right, no one's paying attention to the supply side, and housing is a good piece of that puzzle. How do we get ourselves out of this mess? Because we need more houses to really fix the problem that we're in, right?
Yeah, we definitely need more houses. Right?
Yeah,
from the opening comment. I'll tell you this: I'm seeing it just from my contingency of friends and customers back in New York. There's a ton of capital being infused into build for rent, new construction.
It's good.
It is good. And but you're also seeing, a lot of homes that maybe weren't desirable in great MSAs that needed to be rehabbed. That's going to help out as well.
Agreed.
So it's going to take time. Nothing happens overnight. So this is the way we think about this. It's a marathon. It's not a race. But again, we have some concerns about this. Some of the bigger cities, like a Phoenix, where you could just keep building forever there.
Yeah.
A lot of cities aren't like that. It's just a flat map, and
right.
It's a grid that just keeps going and doesn't stop.
Right.
So I think there's no barriers to entry there. There are barriers to entry in other cities. But again, it's if you look at the Southwest and the Southeast, affordability is much better than other parts of the country. Sure. And you have big employers moving there. So I think we're not expecting a massive housing crash, but I think some cities have to sort of level out and readjust.
Right. But will it take something as dramatic as some type of tax incentive or zoning incentive or something like that? Like, we here in California had that ADU thing. They made it easier to get approvals for ADUs. I felt like it wasn't enough. Like, we need to, what kind of roadblocks can be removed to facilitate that? Because a lot of arguments are being made that even if you were to infuse capital, there's just not enough. Yeah, there's just not enough on the build out side, right? It's hard to get going.
Yeah, I think politics will ruin any chance of anything positive getting done.
That's true.
It's if we threw out the far right and the far left and had a down the middle group of people, things would get done. But I don't see anything coming out of the government or the politicians that's going to help this. ADUs are great, but again, you also have the other problem is look at who's competing. And I know this has been talked about a lot. Investors are competing with first-time homebuyers to buy homes.
Yes.
So something else that I know there's been some comments and potential bills put up, and which I didn't agree with. I think you guys took the same stance we did.
Yeah.
But I think one of the things that would help is a lot of these municipalities, when you go to build new construction, and I've seen it firsthand, it just takes too long. And the whole process, it's not efficient. Some cities are worse than others. Some cities are a lot better than others. But if they could streamline that process where it wasn't so belaboring, we would have a lot more homes. But that's just not the case. They're understaffed and undereducated, in my opinion.
Exactly. And there's a lot of they don't really understand. They when they see a build out and they automatically think, like the only thought process going on at the legislative level is affordable housing, and that's just not enough. If you concentrate on affordable housing and help that, you're not going to help the overall inventory. It's just a subset of the inventory. But what's interesting, what you said was the iBuyers, but on the flip side, the iBuyers themselves are actually struggling, which I was actually excited to see when companies like Zillow and Open Door are kind of getting away from this a little bit. They're not as excited about this sector anymore, or they can't keep it up because there's massive losses.
They don't have a choice to not be excited. This is their business model. And I had met with, I'm not going to name the company, but I had met with one of them at a conference. And I had framed the question. I said, home prices don't go up forever. How does this work when things change? And they're like, we'll just keep flipping homes and we'll earn our way out of it. Well, obviously that doesn't work like that. Because everything changes, leverage changes, execution changes. And, add on top of all this supply chain issues and everything in between. Now you have higher rates, less demand. I think the people that just thought, we're going to be in this home flipping business and everything's hunky dory and there's going to be no issues. This is the most cyclical, business. Well, one of them in the United States is the housing market. It goes up and down violently, and they've got, but I'm hoping they get through it. I don't want to see anyone in this business go out of business.
No, for sure.
But tough sledding for all of us, but them as well.
So let me ask you this: since you've seen the cycles, right? You were on the ground floor during the crisis. What do you think it's going to take for lenders to make it through this next kind of correction? Because we're definitely facing one. I mean, I don't know if anyone disagrees that we're not facing one. So, what's it going to take for someone a lender out there, one of our listeners, either small or big, to make it through this next cycle?
It really depends on how you're structured.
Sure.
I stepping into to Acra and understanding, first you have to understand your balance sheet. What is your liquidity? Who are your capital partners? How committed are they to the private lending space? Because when we originate a loan, and for the listeners who are going to listen to this, we don't have the luxury of going to Fannie and Freddie and delivering at the cash window and saying, "Hey, I originated this. Take it off my hands."
Right.
We are dependent on private capital. So I think, understanding liquidity is paramount. It just is. And one of the lessons that I took into this is, especially coming into this year is, and I've said this before, we are not in the storage business. We're in the moving business. So my thoughts to people that are out there is, when you originate a loan, sell it as fast as possible. Don't wait for the market to correct. The housing market is too big and this moves too fast, meaning prices move too fast up and down. In this case, the first eight months of the year, down significantly. 4.5 coupon loans now, if you still are holding them, you're not going to get 90 cents on the dollar. You could be mid to high 80s for a 4.5 coupon. So that's a big loss. And if you took the side of waiting for the market to come back, you could have problems. So you just got to stay vigilant and keep the machine moving. Keep selling.
So in the same note, the secondary market has presented challenges for a lot of lenders out there, right? And so with pricing,
so that goes back to my other part. You have to know who your capital partners are, and you have to know how committed they are to this business. Right. And if you're selling loans to someone who's in it for the short term, that's probably not the best capital partner. You might want to find someone who's got the sticky money that cares about this. That's
the answer. The sticky money, right? The sticky money, because that they have to care about it and they have to be able to manage it. And whether it be an institutional, I don't know if this is true, but we've been hearing a lot of interest from life companies, right? This is now becoming the darling of life code. One darling of Wall Street, now darling of what life codes, right? So and that seems to be the switch over from a capital source perspective right now, at least.
Yeah, I think We've recently partnered with a fantastic insurance company. Again, committed to the space,
right?
And wants good loans.
Right.
The difference of what happened and why insurance companies are coming in when rates were low and non-QM loans were trading at 107, the math didn't work for insurance companies. When you get the loan price below 103, the math really starts to work. That's why insurance money is stepped in.
For our audience, explain that, because I know what you're talking about. I just read a paper on this recently, but for our audience, please give us a little more.
Yeah, so insurance companies have to match their liabilities to assets, and they need duration on these assets. Non-QM is a great place to pick up spread, over agencies or other products. And I think the insurance companies have spent a lot of time over the last couple of years getting comfortable with non-QM, the performance, what's behind the loans and who are the borrowers. And when you're trading loans at $105, $106 price, the math doesn't work on the total return that they need on that investment. But when you get down to the 103s or 102s, the math definitely works. It's an attractive asset for them that they have a lot of demand for. And given where loan prices are, because of where interest rates and volatility in the securitization market, loan prices are in the 10, from anywhere from par to 102 or 102.5. And this is a sweet spot for insurance companies. And I think this, they're putting their foot in the sand and saying that, they want as many non-QM loans as possible.
Right. And it seems to be that they're interested in not just
same thing in RTL as well.
Yeah.
Yeah, that's right.
I mean, on the RTL side, what's always been fascinating is it's not really a premium trading business. There was always been spreads and stuff like that, but it was never a big premium trading business. But what's been fascinating is that the amount of risk they're willing to take, because you see the amount of leverage they're taking on to balance sheet these loans, and then they're going to do what they will with them.
That's right.
They're really into it. Like, it was surprising because not 5 years ago they would only touch your average CRE deal. But now they're really excited about the space. I'm more exposed to the RTL lenders by virtue of who I am and who I serve. But what's fascinating is the amount of activity that we're seeing, both with the aggregators who are working with them, but also are retail clients, right, who have their own small funds, and some of them are growing quite big, and they're working with now, they're negotiating with life cos.
Yeah.
And so it's been fascinating to see how much stickiness, right, the commitment that we didn't used to see. Because I remember 8 years ago we were talking with a life insurance company in New York, and it was they were not very clear on what they wanted. And I think what the problem was, they couldn't understand the sector. And so now, 8 years later, they really get it.
That's right.
And it makes me wonder what it is about it, because nothing's changed really, right?
No, it goes back to, I think it goes back to understanding, getting comfortable with the asset and how it's originated. And again, it was a novel, this new idea that came out for fix and flip.
Mm-hmm,
and I think there was issues about, okay, how scalable is this? And is this something like, if you're talking to a life insurance company and they're going to bring on a new product, there's a lot of brain work that they do to make sure that this is going to work and it's a good investment. And they don't race into anything. It's a walk
slow and sure process.
Right? Yeah, walk before you run. And now you're seeing a lot of them get very comfortable with the space and getting very comfortable with the underwriting and the originators that are originating.
So, question for you, and then in the same kind of vein of the topic, is the securitization market ever going to come back?
Yeah,
for this RTL stuff.
No, of course. Yeah, I believe it will. I think, like I said, I think institutional investors are waiting to figure out, number one, how high are rates going to go. If they keep going up, they're probably going to stay away from RTL in some form or manner, depending on what the after repair value is and who again, there's a trust aspect when you're dealing with this, how much work is being done on the underwriting side and so forth. So I think people are still comfortable with it. There's liquidity.
So they're just trying to figure out, they're just trying to punch the numbers, make it.
Yeah, but I don't think they're racing to load the boat on RTL right now, but selectively, they absolutely want to add the exposure. And they want to, there's an aspect too, we've never seen this before, but actually we were asked by one person, but, investors that are buying loans now want to know that the originators are going to be alive, because the originator makes reps on the loans that they're making.
Oh, yeah.
So institutional buyers that buy loans are asking originators, can we see your financials? We want to know that you're in good shape and your balance sheet is clean. And
that's becoming more and more of a topic. It wasn't a topic, not even
that's right.
2 years ago. Balance sheet? I don't need a balance sheet. That was the story. And the more and more I talked with folks that were buying loans upstream of the aggregators, and I started talking to them in personal meetings and asking them, the big conversation around balance sheet became a thing. And how much risk can you absorb compared alongside with me? Because I'm not taking all the risk.
Yep.
Yeah, and that's great. I think that's a really good idea, because that once again bolsters the industry to embrace better practices. Right? We don't want to be.
That's exactly right.
Right.
That's right.
And what's fascinating though is on the non-QM side is we've seen such market disruption lately, and a lot of folks are struggling. A lot of shops are. I mean, some of them are gone. You mentioned Sprout earlier; they're no longer around, and a lot of them have really gone, fallen apart. And because I'm not really that involved in the sector, I've always wanted to ask you specifically this. I was going to ask you this at the conference in a few weeks, but like, what's going on in that sector that's causing all that? Because it's been really strange to see some of these companies.
It goes back to what I said earlier. Sprout got stuck with a lot of loans that they should have sold months prior. And if you're not constantly recycling your balance sheet, and you're holding on to loans thinking, oh, I don't like the bid today, I'm going to wait, next week it'll get better. It's never gotten better. It's been a one-way train where prices keep heading south.
Yeah.
And that was part of it. And then, there was other aspects, right? Think about people that hedge. The rates markets have been so volatile. And when you hedge and you have a counterpart, you have to true up that day. That night, you true up. So if you make money, great, you true up. If you lose money, you got to true up as well.
Yeah.
So there was, when rates rallied there at the end of August, coming into September, that was super painful. I'm sorry, maybe it was July. I'm blanking on when the rate rally was. But that was very painful for a lot of originators.
Oh, sure. Massive liability on the books.
Yep.
Yeah.
That's right.
Well, that explains a lot. That really does. All right. Well, I mean, enough doom and gloom for this one. I want to make sure we talk a little bit more about, get to know a little bit more about you guys and what you're working on. So you mentioned you recently added RTL. And so I wanted to ask you what are you guys working on for the near future? We're coming toward the tail end of 22. We're heading into 23. What's Acra working on for 23?
Yeah. So again, I had mentioned earlier that wholesale was the driver behind Acra when we bought the company, and now we have a lot of initiatives. One of them growing wholesale. We hired the West Coast team from Sprout. They've been fantastic.
Awesome.
Huge addition to Acra. They're extremely knowledgeable and adults in the room, which is, and we're still hiring. We're still hiring. We have multiple positions open on sales and operations. And so we want to keep continuing to grow wholesale. Same thing with correspondent. Jeff Lemieux, who runs that business, as a concerted effort. We're again, it's the correspondent business has a little, a higher level of risk because of the timing to get loans up and down.
Yeah. And
to get a TPR review, but that's something that we're comfortable with. And same thing on the retail side. Retail was 3%, 4% of our production when I stepped into the company. Now it was as high as 10% of our production, maybe a little bit higher. So we're going to keep hiring experienced LOs that understand non-QM, that can talk to our customers. And I think, from that, we're then going to start targeting what are the top 10 to 15 MSAs in the country, and either opening locations or have a concerted marketing effort to really tackle the MSAs that we're comfortable with and our investors are comfortable with. So that's non-QM. And then I would say it's the same thing on the RTL side. We want to, our goal in the next year and a half is to get RTL up to the same origination levels as non-QM. So we got some wood to chop, but
yeah,
it's a challenge and we're looking forward to it.
Well, there might be some opportunities as things progress. I mean, RTL is where I live and breathe, and there's probably going to be some opportunities to pick up some, not just talented people, but also some opportunities as there's more displacement going on. It's going to continue.
Yeah, we exactly right. We would absolutely look at platforms that are struggling and, either partner or acquire. So that's another thing that we're paying attention to and speaking to different people. And, I think, we've been waiting patiently to get our Fannie and Freddie tickets. I think that's something that's going to naturally come our way as more people are going out of business, unfortunately. But, and it's always easier to acquire a company that we think has a good management team and a good process in place, as opposed to trying to build it from scratch. So,
right.
So the way I think about it is, no matter where rates are, where unemployment is, where housing is, whatever it is, whatever situation we're in, that we've got business verticals at Acra that are profitable. We learned a very valuable lesson that how important our servicing platform is. When COVID hit and we had to shut down the company, we were able to keep 170 people full-time based just on our servicing business.
Right.
And our servicing book has doubled in the last 2.5 years.
I love that.
So we just got to keep building these verticals that we think at the end of the day are a positive for the Acra platform and can add value moving forward to our clients.
I love that. All right, so I want to close the interview with some kind of rapid fire questions about to you directly, Keith. We always ask our guests these questions. They're a little more fun. So the first question I have is, what was your very first job? Your very first job? My
very first job, I pumped gas. Now you have to think about this. In New Jersey, gas? Well, in New Jersey, you can't pump your own gas. And my father's friend.
That's a real thing? That's not a myth?
No.
Oh, I didn't know that.
You cannot do it. So my father's friend owned a gas station. So
I did not know that was a real thing. That was one of those like urban legends you talk about. That's cool. So it's still retail, customer focused, right?
Yeah.
That's cool.
There you go.
Cool. Yeah. So before we go on that, you're a transplant to California then, right? You live in New York?
Yeah. I was in Manhattan for 19 years.
And then you moved to California when you joined Acra?
When we were going to acquire the company, my CEO had asked, and our management team back in New York asked I raised my hand, but they said, "Would you like to go run it? Your background matches perfectly. It was your idea to do this." And I my hand couldn't have gone up fast enough.
Right.
And they were like, you should probably go check with your daughter real quick, which I did. And we couldn't be happier. It's been nothing but a fantastic experience relocating to Newport Beach. And
yeah, it's pretty nice over there. Yeah.
But also being here at the company as well.
Oh, for sure. But that's a big move.
Yeah, it was.
Yeah. And when was that? How long ago was that with California?
That was in February of 2020.
Oh, that's recent. Like right at the height of COVID.
Well, that's right when we bought the company on Valentine's Day of 2020. Well, to your point, you brought up a good point. 50 days after getting here, after we bought the company, I had to shut it down because of COVID. So,
that must have been fun.
Very fun.
Oh man. All right. So the next question is when you aren't out there building this amazing non-QM and RTL business, what do you do in your spare time now that you're here in California in Newport Beach?
Yeah, I hang out with my family. We are water people. We have a small boat, so we'll take that out on the water. Newport, nice. Newport Harbor is beautiful.
Oh yeah.
And then traveling up and down the West Coast has been great because coming from the East Coast, I really didn't come here. I'd come here for work for a day or two and then fly out back to New York. But going up and down the coast from San Diego up to Santa Barbara and going out to Palm Desert, it's been great to learn and see the different areas.
See all the different types of nature we have, right? Because we've got mountains, we got oceans, you got it, you name it. We got a desert, we got all of it. So that's very cool because I love to hear that because California has so much to offer from that perspective.
That's right.
So much cool to see. All right, last question for you. Last question for you is gonna be: what's one business tool that you cannot live without?
It's got to be my Bloomberg terminal, which just provides me massive amounts of information, data, and knowledge. It's not cheap. You can sign up for Bloomberg, but the amount of information that I'm able to digest and retain, throughout the day, it's instrumental because, again, it starts, sounds cheesy, but our business, right, is sort of, it's the beginning of what affects a lot of things throughout the world. So meaning when interest rates are going up and mortgage rates go up, that's affecting, everyone's daily lives.
Yeah.
And then from there, it's affecting corporations and spending. And so I think, knowing what we do, following the markets and just having access to information, I can't, I have a level of ADD where I got to keep doing something. And for me, it's reading articles and catching up on what's going on.
I love that. Yeah. I mean, that's a first for the show. And I don't think a lot of our guests have had Bloomberg terminals, but the ones that have access to them didn't say it. So I love that. First for the show, but it's very cool. I've actually had the pleasure of working a Bloomberg terminal when I worked at the commission, and that thing is hard to use. So
it's like once you get used to it, it's like riding a bike. It's really
I did not know how to use it. I basically spent probably a week on it, and they figured, oh yeah, you're young, you can figure it out. No. All right. Well, I think that's all the time we have for this episode of the Lender Lounge. Keith, thank you so much for joining us on the show, and hopefully we'll have you back live and in person because I know you're moving. Your office is moving to Irvine, so we should definitely do one live. And for all of you listeners out there, we'll see where we land in this market. But I think all things being equal, this industry still has a lot of tailwinds behind us. So let's good luck to everybody. This is Kevin Kim for Lender Lounge signing off. Thank you very much.
Thanks for listening to Lender Lounge with Kevin Kim. I hope you enjoyed this episode as much as I did. If you did enjoy, please leave us a 5-star review on your podcast platform. And be sure to follow our show to be notified of new episodes. If you're on YouTube, don't forget to smash that like button and hit subscribe for more content from all of us here at Geraci. Lender Lounge with Kevin Kim is available on all podcast platforms. Referrals really help us spread the word, so please send this over to someone you think might enjoy it. See you next time. This is Kevin Kim, signing off.